For Chapter 19, we only cover the one section on bonds, and this is the only section in our current material that you are going to use your time value money keys and your financial calculator again. So the first part of the section on bonds, though, just kind of discusses the basics of what a bond is. So bonds are just basically the way a corporation borrows money from investors rather than banks. So, if you have money in a 401k, you could have your money invested in a bond fund. Well, those bond funds are bonds that are created by corporations, and they're in $1,000 increments always, and they're issued out again for the way that corporation can raise money. And it's a loan, so they're going to borrow $1,000 and then pay you back as the investor at the end of the life of the bond, which maybe is 10 years or 15 years. And you as an investor don't have to hold it that whole time. You could in turn sell it, but if you did hold it, the corporation would pay you your $1,000 back. Some bonds pay interest, and those interests are going to be at what they call a coupon rate or a stated rate. And that coupon rate or that stated rate does not ever change over the life of the bond. So interest rates in our economy change all the time, but once the bonds are set up, so say they're 10 years or 15 years and they pay 5%, that 5% is the coupon rate, and that is always going to be what is paid regardless of what is happening with interest rates in the market. So the future value of the bond is always the face value, or that $1,000, because again, you're going to get that back. The payment that you receive on the bond each year is going to be your interest. And then what happens is sometimes the bonds don't sell today for the $1,000. Especially say if it's the bond is a 10-year bond and you're 5 years into it and somebody goes to sell it, the price that someone is willing to pay at that point in time is probably not going to be the $1,000 that's owed. It's probably going to be a little bit different. So some of the terminology that you want to understand: the face value or the par value of the bond is $1,000. And again, that is what the company is legally obligated to pay you back at the end. The coupon rate or the stated rate is the percent of interest that will be paid annually or semi-annually, however often the company has decided to pay interest. The yield rate is what's going on in the market. So like I said, that's what changes. So the yield rate is going to be something different, and that's going to factor in how much people are willing to pay for the bonds if they're buying them today. So like I said, because if it's sold at any time during the life of the bond, people are probably not willing to pay the $1,000. If they pay less than the $1,000, those bonds are considered to be sold at a discount. If they pay more than $1,000, they're considered to be sold at a premium. And again, it all depends on what is going on in the market, if those bonds will be sold at a discount or a premium. So then the textbook provides us with a bond table, which is something like you would find maybe in the Wall Street Journal or a financial publication that you could look up. Hey, the IBM has these bonds, and what are they paying and what are they selling for? So you want to be able to kind of look at that bond table in the textbook and understand how to read it. But the coupon rate is that interest rate of interest, that percent of interest that they're paying. There's a rating, so like a AAA bond is the least risky, a double C bond is the most risky, and then there can be bonds in between there. They'll show you the high, the low, and the last. So what you want to focus on is the last. Whatever the bonds closed at on that day would be considered their current selling price. And then what you want to remember when you see that close price, it really is a percentage. They don't show you the percentage sign, they just put in the numbers, but you just have to know that that last, the high, the low, and the last are all being expressed as a percent. So here's an example. If it's got the coupon rate of 7.55, that means it's paying 7.55% of $1,000. So that would be a $75.50 interest payment each year. And then if the closing price is 120.696, that's 120.696% of $1,000. So it would be $1,206.96, which again is over $1,000, which means it's being sold at a premium. Then the cost, though, the total cost that the person pays may also include some fees. So here's another example. This one, you buy multiple bonds. If you buy 25 bonds and you're paying a $5 sales charge per bond, and they closed at 76.75 and they're paying 7.75 interest. So the cost is going to be the 25 bonds times the 76.75, again, it's a percent, times the $1,000. So the net cost is $19,187.50. They're selling at a discount. But then plus you have to incur the $5 times the 25 bonds, the $125 charge that the broker is charging you. So the total cost to the person who's investing, or the group of investors, would be $19,312.50. But again, those are selling at a discount because they would really be worth $25,000 at face value. Their annual interest is going to be the $25,000 times the 7.75%, or $1,937.50. And then if you wanted to know, well, what am I actually earning on that? You take your annual interest and divide it by your total cost. So in this case, you would be actually earning 10% on those bonds. Okay, then when we get into calculating the actual value, we want to go back to our time value of money keys. So this is the only thing in our current material that we use the time value of money keys. And this is how the bonds will always be set up. So our N is going to be our number of interest payments. Our PMT is going to be the amount of the interest payment. So that is the $1,000 times the coupon rate. The face value is always $1,000 on a bond. And then the IY is whatever the current market rate is. So the IY is the thing that changes, depending on what's happening in our market. And then you're always computing the present value of the bond. So if you were to have one of these on your test, you want to know what goes in each one of those keys, the N, the PMT, the FV, the IY, and then you're computing for the you're computing for the PV. So here's an example. If this company issues $100,000 of par value bonds at a 9% coupon rate with interest paid semi-annually for 20 years, similar bonds are yielding 11%, how much will they sell for? So our N is our number of interest payments, so the 20 years times 2, because they're semi-annually, that gives us 40 interest payments. The IY is the market rate, so similar bonds yield 11%. That 11% is the market rate. We're going to divide it by 2, though, because it's semi-annually, so that's 5.5% each semi-annual period. The payment is going to be the $1,000 par value times the 9% coupon or stated rate, and that would be $9,000 a year, but in this case they're paying it out semi-annually, so we need to divide it by 2. So that's $4,500 each 6 months. The face value of the $100,000 is what the company owes back at the end, so that is our future value, and we'll compute the present value. So then we see when we compute the present value, we would pay $83,953.88 for these bonds, which means they're selling at a discount. And they're selling at a discount because they are paying only 9% in interest, and other bonds of a similar nature are paying 11%. So people are not going to be willing to pay the whole $1,000 per bond. They'll have to be sold at a discount. So that is kind of the general overview of bonds, but you want to understand how to compute the present value as well as to read those bond tables.